You are 24 years old. You have $2,300 in a checking account. Your rent is $895. You got your first salary job 7 months ago. The pay is $52,000 before taxes. Your take home is $3,160 per month. Both of you. That's where this splits. Path A. The early investor. Age 24. You open a brokerage account on a Wednesday night. The interface is simpler than you expected. You link your checking account. You set up automatic investments. $500 per month, every first of the month. The money buys into a total market index fund. Expense ratio 0.04%. You do not understand what expense ratio means yet. You learn 3 weeks later. It means how much the fund costs you annually. 0.04% is $4 per year for every $10,000 invested. You are paying almost nothing to own a piece of 3,700 companies. The first transfer processes on April 1st. Your brokerage balance is $500. The market is open. The shares purchase automatically. You own 4.73 shares. The price is $105.67 per share. You check the balance April 2nd. It is $490. You have lost $8 in 1 day. You do not sell, not from wisdom, from inertia. You are busy. You forget about it. Month 2, the automatic transfer happens again. You do not notice it leave your checking account. You have structured your budget around $2,667 per month, not $3,167. The $500 is invisible. You never touch it. You never miss it. This is the entire strategy. By the end of year 1, you have invested $6,000. The account balance is $6,340. You have gained $340 from market growth. You do not celebrate. You do not tell anyone. It is simply a number on a screen that you check once every 6 weeks. Path B, the delayer, age 24. You have the same $3,167 per month. You think about investing. You listen to a podcast about index funds. It makes sense. You tell yourself you will start next month. Next month, you need $480 for car repairs. The investment waits. Month 3, you start. You manually transfer $500 into a savings account. It earns 0.5% interest. You tell yourself this is basically the same as investing. It is not the same. Month 5, you need $800 for a wedding gift and travel. You pull it from the savings account. The balance drops to $100 to $200. You are not irresponsible. You are flexible. Flexibility is the enemy of compounding. By the end of year 1, you have $1,740 in the savings account. No investment account, no exposure to market growth. You are not behind by much. Just $4,600 in invested principal and $340 in growth. The gap is $4,940. It does not feel significant. It is the most significant number in your financial life for the next 40 years. Path A. The early investor. Age 25 to 29. You get a raise at 25. Salary goes to $57,000. Take home increases to $3,458 per month. The automatic investment stays at $500. You do not increase it. Not from discipline, from forgetting it exists. The automation runs in the background. January, February, March. $500 leaves. Shares accumulate. At 26, the market drops 11% in 6 weeks. Your balance was $16,200. It falls to $14,420. You lose $1,780 in a month and a half. You check the account on a Tuesday morning. You feel mildly nauseous. You do not sell. You are busy with work, a project deadline, a performance review. By the time you check again, 8 weeks later, the balance is $15,190. It has recovered most of the loss. You learn something without reading a book. Declines are temporary if you do not sell. At 27, you increase the automatic investment to $650 per month. Your salary is now $64,000. Take home is $3,140. You can afford the extra $150. The adjustment takes 90 seconds. You change the recurring transfer amount and close the app. By 29, you have invested $43,300 total. The account balance is $53,680. The market has returned an average of 9.2% annually. You have earned $10,380 in growth. You have done nothing to earn this except not sell. The $10,380 appeared because you left the money alone and the economy grew. Path B, the delayer, age 25 to 29. At 25, you take a vacation, Costa Rica. The trip costs $2,100. You pay for it from savings. The balance drops to $890. You rebuild it over 7 months. By 26, you have $3,200 in the savings account. It feels responsible. It is not growing. At 27, you buy a car. Used, $18,400. You put $4,000 down. The payment is $310 per month for 60 months. Insurance is $160 per month. You now have $477 per month in car costs. The $500 you were going to invest is now $477 in car obligations and $23 left over. You do not invest the $23. At 28, your salary is $66,000. Take home is $3,140 per month. After rent, car, insurance, utilities, groceries, and discretionary spending, you have $620 remaining. You think about investing. You still have not started. The thought occurs on the 1st of the month. By the 4th, the thought is gone. By 29, you have $8,100 in savings. You have invested $0. The gap between you and Path A is now $53,680. You are the same age. You have made approximately the same income. One of you automated a decision in year 1 and never revisited it. The other delayed the decision 83 times. Path A, the early investor, age 30 to 34. At 30, your investment account crosses $70,000. You have contributed $51,100. The market has contributed $18,900. The market's contribution is now 27% of the total balance. You are no longer the primary source of growth. The compounding is. You get married at 31, your spouse has $12,000 in an investment account, you combine finances, you keep both accounts separate but aligned, the household investing is now $950 per month combined, your account continues at $650, hers continues at $300. At 32, the market has an exceptional year. Growth is 21%. Your balance starts the year at $87,400. By December, it is $110,200. You contributed $7,800 during the year. The market contributed $15,000. You earned more from growth than from your contributions. This is the inflection point. You are now working for the portfolio. The portfolio is not working for you. At 34, you receive an inheritance. $22,000 from a grandmother. You invest all of it. The decision takes 4 minutes. You do not buy anything with it. The account balance jumps to $156,800. You continue the $650 monthly contributions. They feel small now compared to the balance, but they are not small. They are $7,800 per year, every year, forever. By 34, total contribution $71,100. Account balance $176,300. Unrealized gains $105,200. The gains are now larger than everything you have ever contributed. Path B, the delayer, age 30 to 34. At 30, you decide this is the year, you are going to invest, you research brokers, you read articles, you compare fees. This takes 11 weeks. You do not open an account during those 11 weeks. Research is not progress, it is delay disguised as diligence. At 31, you finally open a brokerage account. You transfer $1,000. You do not set up automatic investments. You tell yourself you will do it manually each month. Manual processes do not survive contact with life. Month 2, you transfer $300. Month 3, you transfer nothing. A dental bill. Month 4, $500. Month 5, nothing. A friend's bachelor party in Austin. By the end of year 1 of investing, you have contributed $2,800. The balance is $2,250. You have $150 in gains. It does not feel like enough to matter. You are correct that $150 does not matter. You are wrong about why. The $150 does not matter because it is year 1. Year 1 never matters. Year 16 matters. You are not building year 16. You are stopping and starting. At 33, you have a child. The costs increase. Childcare is $1,200 per month. You stop investing entirely. The brokerage account sits at $6,400. You do not add to it for 18 months. You are not wrong to prioritize childcare. You are wrong to think it is binary. You could have automated $200 per month. You did not. By 34, you have $9,100 in your investment account. Path A has $176,300. The gap is $160,200. You have been alive the same number of days. One of you has $160,200 more in assets that grow without labor. Path A, the early investor, age 35 to 39. At 35, your salary is $98,000. Your spouse makes $71,000. Combined household income is $169,000. The automatic investment is now $1,100 per month combined. You increased it twice. Once at a promotion, once when childcare costs dropped because the kids started public school. The account balance at 35 is $198,000. You max out your 401k for the first time. Contribution limit is $23,000. Your employer matches 5%. They add another $4,900. Total retirement contributions for the year, $27,900. This is separate from the $13,200 going into the taxable brokerage account. At 37, the account crosses $300,000. You are not rich, you are systematic. There is a difference. Rich is a feeling, systematic is a structure. The structure produces the number regardless of the feeling. At 38, the market declines 9% in a single quarter. Your balance drops from $342,000 to $311,220. You lose $30,180 in 91 days. You do not sell. You have been through this before. The automatic investments continue. $1,100 on the first, every month. The shares purchase at a lower price. You are buying more shares per dollar. This is called dollar cost averaging. You did not plan it. The automation executed it. By 39, the account has recovered. The balance is $407,000. Total contributions over 15 years, $111,300. The market has contributed $295,700. You have made $295,700 from doing nothing except not selling. Path B, the delayer, age 35 to 39. At 35, you decide to get serious. You read 3 books on investing. You listen to podcasts. You understand index funds now. You get it. You increase your monthly contribution to $500. Automatic. Finally. The balance is $11,800 when you start the $500 monthly plan. Year 1 goes well. You contribute $6,000. The balance grows to $19,100. You feel momentum. Year 2. An emergency. The air conditioning unit dies. The replacement costs $7,200. You do not have $7,200 in cash. You pause the automatic investment. You pull $4,000 from the brokerage account. The balance drops to $15,800. You tell yourself you will restart the contributions next quarter. You restart them 7 months later. At 38, your brokerage account has $20,400. You have contributed inconsistently for 7 years. Total contributions approximately $34,000. The balance is below your contributions because you sold during a downturn and bought back in at higher prices. You have executed the opposite of the correct strategy without intending to. At 39, you realize the gap. Path A is at $407,000. You are at $31,200. The distance is $375,800. You feel angry, not at Path A, at yourself. The anger is not useful. The anger does not compound. You decide to catch up. You increase contributions to $1,200 per month. This is aggressive. Your budget is tight. Month 3 of the $1,200 plan, you reduce it back to $600. The budget could not hold. You are trying to make up for 15 years in 90 days. Time does not work that way. Path A, the early investor. Age 40 to 50. At 40, you do not think about the investment account often. It is part of the infrastructure. Like the mortgage, like the insurance. It happens in the background. The balance is $407,000. The automatic contributions continue. $1,100 per month. At 42, you receive a promotion. Salary increases to $127,000. You increase the brokerage contribution to $1,400 per month. The adjustment takes 1 minute. At 45, the account crosses $750,000. You have contributed $199,500 over 21 years. The market has contributed $550,500. The market is now contributing more per year than you are. Annual market growth at 8% on $750,000 is $60,000. Your annual contributions are $16,800. You are no longer the engine. You are the fuel for an engine much larger than you. At 48, the balance is $1,140,000. You are not a millionaire from salary. You are a millionaire from starting at 24 and not stopping. At 50, the account holds a $508,000. Total contributions $304,200. Market gains $1,203,800. You have earned $1.2 million by allowing time and compounding to work without interference. Path B, the delayer, age 40 to 50. At 40, you commit, fully commit. You automate $800 per month. The balance is $31,200. You do not pause this time. The investment runs for 22 consecutive months. The balance grows to $53,600. You feel progress. At 43, another disruption, a job loss. Severance lasts 10 weeks. You stop the contributions. You do not sell, but you stop adding. The pause lasts 14 months. By the time you restart, the balance is $51,900. It grew slightly, But you missed 14 months of contributions at lower prices. At 47, your account holds $118,000. You have been investing on and off for 16 years. Total contributions $97,000. Market gains $21,000. The gains are small because the consistency was broken 6 times. Each break reset the compounding curve. At 50, the balance is $186,000. You have contributed $142,000 over 19 years of sporadic investing. Market gains $44,000. Path A holds $108,000. You hold $186,000. The gap is $122,000. You are the same age. You experience the same market, the same recessions, the same recoveries. One of you started at 24 and automated $500 per month before life got complicated. The other one waited until life made sense. Life never made sense. The market does not wait for your life to make sense. Path A, extrapolated to age 65, the $1,508,000 at age 50 continues to grow. Contributions continue at $1,400 per month. Average return 8% annually. At 65, the balance is $5,127,000. Total contributions over 41 years, $508,000. The market contributed $4,619,000. You turned $500,000 in disciplined contributions into $5.1 million by starting early and not stopping. Path B, extrapolated to age 65. The $186,000 at age 50 grows with $800 monthly contributions. Same 8% return. At 65, the balance is $901,000. Contributions over 24 years, $278,000. Market gains $623,000. You are not poor. $901,000 is a successful retirement account, but it is $4.2 million less than Path A. The only difference was 16 years. Path A started at 24. Path B started at 40. Same market, same strategy once started. The 16-year head start produced a $4.2 million difference. At 24, both of you had $2,300 in checking and $3,165 in monthly take-home. One of you set up a $500 automatic transfer on a Wednesday night and never turned it off. The other one researched and planned and waited for the right time. The right time was Wednesday night at 24. There was no better time coming. The compounding does not care about your readiness. It cares about time in the market. Path A gave it 41 years. Path B gave it 25 years. The difference in outcome was not linear. It was exponential. The Tuesday after that decision still came. It always does. For both of them.